Good morning, traders. It's the 28th of February. I'm Joe Neighbour from Signal Centre talking bull this morning. No, Steve, he's off enjoying a couple of days break for his birthday. So he'll be back tomorrow morning. Steve, if you're watching, hope you're having a great weekend. Okay, let's get stuck into it then. So it's been, again, a weekend that's been dominated by the developments in Ukraine and the geopolitical tensions that continue to intensify. The Ukraine headlines have continued to dominate market moves. Sentiment was notably more constructive on Friday following reports that there could be peace talks between Russia and Ukraine in Minsk. Over the weekend, the EU announced additional sanctions against Russia, while there was a notable U-turn from Germany as it announced a big increase in military spending and also announced that it would send arms to Ukraine. Western countries announced that they would look to block Russian access to currency reserves, and many Russian banks will be frozen out of the SWIFT system. The EU also announced that it had closed airspace to all Russian aircraft. Russian President Putin announced that Russia nuclear forces would be put on special alert, and there were attacks on Ukraine from Belarus. So we have opened up pretty dramatically lower in most risk assets this morning, although they are bouncing off of their worst levels. And I imagine it was that trigger of the word nuclear that has caused all of this selling to occur. Obviously, the nuclear option um, is a scary one for everybody, and that will put markets on edge. In terms of what's going on in terms of risk appetite, the market mood was much more positive on Friday. There were big gains across risk assets and really huge reversals. In fact, with the S&P 500 index, for example, gaining 2.2%, while there were substantial gains for wider risk assets and a dip in demand for defensive ones. Oil prices continued to surge again. They posted net losses on Friday, although global benchmarks did recover from intraday lows. Prices again jumped in Asia overnight and on Monday as Ukraine fears increased again, although there were no direct measures against Russian energy exports. Markets were concerned over the threat of supply disruption. In terms of what's going on with US inflation data, that takes second fiddle. The US core PCE price index increased 0.5% for January, which was in line with expectations, while there were year-on-year increased. There was a year-on-year rate increase to 5.2% from 4.9, which was slightly above the market expectations of 5.1%. Markets continue to expect that the Federal Reserve will increase interest rates at the next policy meeting, which will take place this month, and there is expectations of a 0.25% hike in interest rates this month. Potential for some month-end positioning today. It's the last trading day of the month, so that can increase volatility and lead to some sharp moves. So we'll get stuck into some charts now. Just going to expand on the chart that we've got here, which is the dollar index. Starting off with the FX markets, this had a really strong push to the upside on Thursday last week, reaching a really key resistance level that we've got on our charts at 97.72, which is highlighted here. This is a 61.8% Fibonacci retracement level of this entire move here that you can see from the highs that were posted in March in 2020 down to those lows that were posted in early 2021. So a really important level, and it's done a pretty good job of rejecting prices at the moment. Overall, we're still trading in this bullish channel, and we are posting some pretty strong stuff today, up by almost 0.75% as things stand. So look set to go and test that resistance level again, and just highlighting the appetite for more defensive assets at the moment, given what we are seeing in the geopolitical scene at the moment. Looking at some of the other risk assets, Aussie versus US dollar, you would expect Aussie to not be performing so well in a risk off environment. Most of these Aussie prices actually gapped lower overnight. Just going to take a look at the intraday charts here just to give you a bit of an idea of what I'm talking about. So this is the hourly chart on Aussie versus US dollar. This is where we closed on Friday. This is where we opened overnight at 10 o'clock UK time, when we got our first look at the price of the futures and what was set to occur. So that was a 1% gap lower pretty substantial, and that was seen pretty much across all of the riskier assets. As you can see here, Aussie CAD has actually overshot the gap, so that hasn't worked as resistance on the first look. But elsewhere, there are many gaps on these charts, and they could present opportunities for speculators to fade into those gaps. Often gaps are filled and they can provide good opportunities for traders. Let's take a look at the daily setup on Euro US dollar. That gapped open pretty much into these lows that we've seen in this big support zone now at 111.21. We've seen a decent reversal and look to be coming close to filling that gap, and that may be where we start to see some short sellers sort of step in to fade that move in line with the dominant trend. So it looks as though although we've seen a decent bounce, we're still down by 0.9% so far today, and we could see some short sellers step in around about that 111.85, 86 kind of level. If we take a look at cable, that again gap lower today. As you can see, the high here, the close on Friday was all the way up here at 134.04, and we opened somewhere around 133.08. So almost a 100 tick move to the downside on the gap on that one. Again, looks as though we may see some resistance around this 133.85 level, and that could attract some short sellers back into the market in line with this dominant trend. Looking at euro sterling, another market where there was a gap. We closed all the way up here around about 83.95, but opened around 83.54. Overall, still looking as though we're going to see some choppy trade on that front. If we take a look at euro yen, that's one of the worst performing currencies today, down by 0.8% so far. As you can see, this is where prices closed on Friday up at 130.11, but we are now down and engulfing all of those gains that we posted on Friday with prices around 129.08. So expecting more choppy price action on a lot of these currencies today. Let's take a look now at some of the cryptocurrencies. They've seen some choppy price action as well, of course. This is the daily chart on Bitcoin. We posted losses on Friday, so it didn't join in the rest of the risk asset rally that we saw on Friday, which was a bit of a surprise. We are posting gains today, though, up by 1.7%. So it seems to be quite a bit of an inverse correlation on these risk moves that we've seen with regards to Bitcoin and other traditional assets. But overall, still remains under pressure, I think, on Bitcoin, and we are maybe likely to see lower prices in an environment where risk assets are kind of taking a bit of a hit. Let's take a look at some of the metals. This is silver. This tried to break above resistance here at 24.7. Big push to the upside on that Thursday, which was then reversed. And on Friday, we pretty much closed where we open, and it's a similar situation. We have seen a decent break of what maybe is a triangle pattern here on the daily chart. So this is obviously the downtrending element. This is the uptrending part, or the sort of flat line to create that triangle. So just go something like, oops, didn't quite get the low, something like that. We've got a bit of a triangle. We've broken out of that, but not really getting the follow through just yet on silver. If we take a look at gold, similar situation. It broke to new highs, or certainly the highest prices we've seen in a number of months, above that 1916 level, but rejected that and closed back below it, and it's still below it at the moment. So it looks as though we're getting a bit of consolidation, maybe between 1877 to 1916. If we can get a sustained push above that, then I think the outlook for gold is looking pretty rosy, and we can maybe start targeting these highs up here from August 2020. Let's take a look at the indices then. So big moves on these markets to start the week. As you can see, we saw this massive reversal on Friday, which would have encouraged a lot of participants in the market. The FTSE 100 is still one of those markets that continues to outperform the rest, and I think a lot of that is to do with the oil influence that is involved in the FTSE 100. Obviously, we've got Royal Dutch Shell and BP, two absolute behemoths of stocks, which have a pretty significant weighting on the overall index, and they seem to be keeping it quite propped up at the moment. So we weren't actually too far away from the highs on that big strong move higher that we saw on Friday, but we've rejected that today. And undoing maybe half of those gains that we saw. So you would expect maybe when you see these Marubozu candles form, Marubozu candles are when you see prices continue to extend from pretty much the open to the close. You tend to see support around about the 50% level, maybe overshooting that a little bit at the moment. I mean, if we end up engulfing all of these gains that we saw on Friday, then I think that would be extremely negative, and we can start thinking about maybe lower prices. But there is massive support here around 72.27, and while we're above that, there is still hope for this to continue moving sideways, maybe to higher prices eventually. But if this level breaks, then I think I'd be a bit concerned, and we can maybe expect to see lower prices over the coming weeks and months. If we take a look at some of the other European indices, this is the CAC 40. This formed what looks to be maybe a head and shoulders top, and looks to be breaking down through the neckline on that today. So we've engulfed all of the gains that we posted on Friday, down by 3.7% as things stand on that market at the moment. If we take a look at the DAX, since breaking down from this range below 14,809, we failed to see prices overcome that level. On this day here, on the 23rd of February, we saw a fantastic retest of that level before selling ensued. We are pretty much engulfing all of the gains that we saw on Friday. We have been as low as 13,942, which isn't the lowest price we've seen in recent times. That is still down here around about 13,800, which was seen on the 24th of February. But all in all, still looks pretty bearish, and I think we can expect to see lower prices. It doesn't appear to be any sort of breakthrough in the stopping of fighting in what's going on in Ukraine and Russia. So while this uncertainty persists, it looks as though the equity markets are going to remain on the back foot. The US markets are not performing as badly so far as the European markets. This is the Nasdaq market. This is this head and shoulders top pattern that Steve and I have been referring to. The neckline of this pattern is obviously moving lower in line with this sort of downward sloping neckline. We so far have seen prices hold on to this support zone, although we did see a massive overshoot lower. On a closing basis, we've managed to close above this level on a few occasions now. So we aren't engulfing quite all the gains that we posted on Friday just yet with this. But I think overall it remains pretty fragile, and things could turn pretty quickly on this if the short sellers start to step in and want to drive this lower. So still mindful of this head and shoulders top, and still believe that lower prices will be seen. S&P 500, again, not quite engulfing all of the gains that we posted on Friday, and still got a way to go before it reverses this massive upward reversal that we saw in price that started on Thursday for the S&P. But looks as though, again, a top is forming here, and we can maybe expect lower prices, particularly if these lows here are taken out on a closing basis. 4220 is the level to watch there on the S&P 500. So that will do. There'll be a more in-depth look at these charts later on in the week when Steve's back, and we can go through these together. But for now, that will do. I was looking at the CAC for my intraday trade on Friday, my gun to the head trade. But as we know, we saw this massive reversal in prices. I was looking to sell into this kind of zone here, but we saw a big shoot to the upside, and yeah, pretty out of nowhere, to be totally honest. But I'm actually going to persist with this again today, just because it keeps things easy for me. I mean, I don't have to trawl through lots of charts right now. So if there was a gun to my head, what would I do with this? I'd be selling it, that's for sure. And the current price is 6546. I'd be targeting a move down to this support I've got here at 6252, and I'd be calling a short-term top in place at the highs that we've posted on today's trading session at, sorry, not quite today's trading session, because obviously we've got this that happened at midnight, but off the back of a small bounce at 6649. So that gives me a risk-reward ratio of 2.8 on the CAC today. The reason I keep selling the CAC is because I envisage it as being one of the weaker markets in the European European cluster of markets that we look at. So for me, that seems to be one of the better bets on the downside for now. And it is, as you can see by looking at my watch list, pretty much the worst performing one, in line also with the Euro Stoxx 50. So that's my trade of the day. Expecting more volatility and more difficult trading conditions. In terms of what we've got due out today on the macroeconomic front, at 2:45 today UK time, we've got the US Chicago PMI index, which is one of those high impact events, but may not have much of an impact on trade today, given there are far more pressing issues going on in the markets at the moment. The other thing to bear in mind is at 3:30 a.m. UK time, so tomorrow for the UK, the Reserve Bank of Australia announces its latest policy decision. So if you have any exposure to the Aussie currencies overnight, there is central bank influence, and that obviously can create lots of volatility and big moves in markets. So do be aware, if you are holding any positions and you're based in Europe overnight on the Aussie, you don't want to wake up with any nasty surprises on that. Big week this week. We've got USM ISM Manufacturing Index. We've got Bank of Canada policy decisions on the 2nd of March. We've then got the Federal Reserve on the 2nd as well. Fed Chair Powell with his latest testimony. And then on Friday, we've got the latest non-farm payroll numbers from the US. So an interesting week ahead on the macroeconomic front. But of course, the Ukraine-Russia situation is front and center at the minute. So be careful if you're trading. Make sure you use appropriate risk management and, of course, use stops. And we'll be back tomorrow with more to update you on the technical side of things. Until then, trade safe, everybody. Goodbye.